J. Demonstrate understanding of compensating balances. Compensating balances are minimum deposits a borrower must maintain with a bank as part of a lending agreement. They effectively increase the cost of borrowing because the funds are restricted and unavailable for use. Although loans may have a stated interest rate, compensating balances raise the effective interest rate. Borrowers must calculate the true cost of funds considering restricted cash. Banks use compensating balances to ensure profitability and offset service costs. They also strengthen the bank-customer relationship. Firms must incorporate these requirements into cash planning. Understanding compensating balances ensures accurate evaluation of short-term financing options and borrowing costs. K. Identify methods of slowing down disbursements. Delaying disbursements allows a firm to retain cash longer and improve liquidity. Techniques must be legal and ethical, avoiding damage to supplier relationships. Centralized disbursement accounts can increase payment processing time. This extends the clearing period before funds leave the company's account. Using checks rather than immediate electronic transfers may increase disbursement float. Scheduling payments on the due date rather than early conserves cash. Effective disbursement management balances cash retention with maintaining strong supplier relationships and credit standing. L. Demonstrate understanding of disbursement float and overdraft systems. Disbursement float is the time between issuing payment and the actual deduction of funds from the company's bank account. During this period, the firm continues to earn returns on the cash. Managing float strategically improves short-term liquidity. However, deliberate abuse may harm relationships or violate agreements. Overdraft systems allow temporary negative balances within agreed limits. They provide short-term liquidity flexibility, but often involve fees or higher interest charges. Controlled overdraft arrangements can support timing differences in cash flows. Understanding float and overdraft mechanisms enhances efficient treasury and working capital management. M. Identify and describe reasons for holding marketable securities. Marketable securities are short-term, highly liquid investments held as temporary placements of excess cash. Companies invest surplus funds in these instruments to earn returns while preserving liquidity and safety. They support transaction and precautionary motives. Instead of holding idle cash, firms earn modest yields while maintaining quick access to funds for operational needs. Marketable securities provide flexibility in managing cash flow timing differences. They allow firms to bridge gaps between inflows and outflows without committing to long-term investments. They can also serve as collateral for borrowing. High-quality securities enhance creditworthiness. Effective use of marketable securities balances liquidity, safety, and profitability in working capital management. N. Define different types of marketable securities. Money market instruments are short-term debt securities with maturities typically under 1 year. They are characterized by high liquidity and low default risk. U.S. Treasury securities include T-bills, short-term, Treasury notes, medium-term, and Treasury bonds, long-term. They are considered virtually risk-free regarding default. Repurchase agreements, repos, involve short-term borrowing secured by government securities. They provide liquidity with minimal credit risk. Federal agency securities are issued by government-sponsored entities. Bankers' acceptances support international trade, while commercial paper is unsecured corporate short-term debt. Negotiable CDs and Eurodollar CDs are large denomination bank deposits. Each instrument differs in maturity, risk, and yield characteristics. O. Evaluate trade-offs in marketable security selection. Safety refers to the likelihood of principal repayment. Government securities offer high safety but lower yields, while corporate instruments may offer higher returns with increased risk. Liquidity, marketability, affects how quickly securities can be converted to cash. Highly liquid instruments reduce transaction costs and financial risk. Yield represents the return earned. Investors often face a trade-off between higher yield and higher risk or lower liquidity. Maturity impacts interest rate risk. Longer maturities generally offer higher yields but greater price sensitivity. Taxability influences after-tax returns. Some government securities may provide tax advantages, affecting overall investment selection decisions. P. Demonstrate understanding of the risk and return trade-off. The risk-return trade-off states that higher expected returns require accepting greater risk. Investors demand compensation for uncertainty and potential variability in returns. Low-risk instruments, such as Treasury bills, provide lower yields. Higher yield instruments, such as commercial paper, carry greater credit or liquidity risk. Interest rate risk increases with longer maturities. Investors must evaluate whether higher yields justify increased price volatility. Diversification can reduce certain risks but not eliminate market-wide risk. Understanding the trade-off supports rational investment decisions and effective cash management strategies within corporate finance.